All right, guys. Since the website was down um, during our scheduled class time today, I'm going to go ahead and make some lecture videos for you to watch instead. Um, this is where we left off last time. We were looking at equilibrium in the long run, which basically is just where all three of our curves intersect at the same place. Okay, so if they're all intersecting at the same point, then the economy is in long run equilibrium. The expected price level is equal to the actual price level. GDP is equal to the natural rate of output, or in other words, full employment output, and unemployment is at its natural rate. So I believe this is where we left off last time. So the whole point of developing this model and understanding this model is so that we can understand and evaluate, analyze, predict even economic fluctuations, right? That's really the whole point. We want to be able to understand um, what can cause a recession, what can cause an economic boom and inflation, and then the next chapter we're going to discuss how the government and the central bank, the Federal Reserve Bank, can get us back to long run equilibrium and sort of dampen the fluctuations, make them less severe. So, make recessions less severe, make economic booms and the accompanying inflation less severe. Um, and so we're going to start basically by analyzing um, economic shocks. Okay. And so these economic shocks are caused by events that either shift the aggregate demand curve and or the aggregate supply curves. And so anytime we want to analyze um, economic fluctuations, we kind of do so in four different steps. And we typically always, I guess not always, but we typically start from long run equilibrium. That's usually our starting point. Um, and then we are told that there is some sort of economic shock, some sort of shock to the economy. And so our first step is to determine whether that event or that shock is shifting aggregate demand or one or both of the aggregate supply curves. And then we determine which way those curves shift. So once we've determined which curve shifts, we then determine which direction. Is it to the left? Does it decrease? Or is it to the right? Does it increase? And then we use our model to see how that shift changes GDP and price level in the short run. And then the last step is to analyze how the economy gets back to the long run equilibrium from this short run equilibrium. sorry, the price level fell by 22%, and unemployment went from 3% up to 5%. So that was a really big deal. The Great Depression, right? Worst economic recession ever in the United States. It was really, really bad, and it lasted for a long time. Well, what got us out of the Great Depression? It turned out to be World War II. Okay, so now we continue on from 1939 to 1944. And in that time period, the government started spending a lot of money on the war effort, right, to combat Nazi Germany and Japan and Italy. Um, and so the government was spending a lot of money on the war effort. Um, Government spending rose from about 9 billion all the way up to $91 billion. So a huge increase in government spending. And that, of course, shifted the aggregate demand curve to the right, and started to help the economy recover. GDP rose 90%, the price level rose 20%, and unemployment fell from 17% to 1%, which is ridiculously low for unemployment. 1% unemployment is probably the lowest it's ever been in our country. Okay, so I'm going to walk you through this example. Typically, I would have you do this in our online class, but since this is a lecture video recording, I'm just going to walk through it. So in this example, we're going to draw the aggregate demand, aggregate supply diagram for the economy. And like I said earlier, we typically start with the model in long-run equilibrium where all three curves are intersecting at the same place. Okay, and then of course we're given some sort of economic shock. In this case, we are told that there is a economic boom that occurs in Canada. Okay, so Canada is getting more wealthy, in other words, right? Now, of course, if Canadians are becoming more wealthy, they're going to buy more U.S. goods, and so net exports should go up, and that would affect the aggregate demand curve. So that's our first step, figure out which curve the shock will impact, and that's the aggregate demand curve. And the second step is to determine which way it shifts, and it'll shift to the, let's see, I can't do this because it's a mirror image. It'll shift to the right, right? Aggregate demand will shift to the right. Is that when you're evaluating a shock, right, you basically want to try to determine, is it going to affect spending, in which case it affects aggregate demand, right? What are all the different ways people spend money? They either spend money on consumption, businesses spend money on investment, the government spends money on government spending, and then foreigners spend money on exports, and consumers spend money on imports, to get us to the net exports equation, right? So if the shock affects spending, then it affects aggregate demand. If instead the shock has an impact on production, right? What can we make? Then it's going to affect either the short run aggregate supply or the long run aggregate supply, depending on what the shock is. And so to discern which of those curves it shifts, you just have to remember what are the things that can shift those supply curves. Long run aggregate supply depends on resources and technology, right? Of course, those affect production. We need resources to produce things. We need production technologies to produce things. Now, I've mentioned before that technology usually doesn't get worse, it only improves, which means changes in technology typically cause the long run aggregate supply curve to always be slowly shifting to the right. And of course, if the long run curve shifts, it brings the short run aggregate supply curve with it, right? They're tied in that way. But there are some things that shift short run aggregate supply that don't affect long run aggregate supply, and those are basically any shocks that affect production but are temporary. They're not permanent, and that's why it's affecting the short run aggregate supply curve. All right. All right, so let's also use our diagram in a case study of the Great Recession that happened back in 2008 and 2009. So from December of 2007 to June of 2009, GDP fell by 4.7%. Unemployment rose from 4.4% in May of 2007 to as high as 10% in September of 2009. And the housing market was playing a central role in this recession. It was mainly caused by problems in the housing market, and then that sort of precipitated other economic shocks. It caused a stock market crash to some degree, not as bad as the Great Depression, but pretty bad. And what else happened? It also affected the financial system. So there was sort of a domino effect that all started with problems in the housing market. So to think about that, here's what was going on with housing prices. So this is a home price index. So as you can see, home prices were steadily rising over the early 2000s into the mid 2000s, and then they kind of flattened out a little bit, and then they started to drop precipitously. So, what was going on here? What sort of caused these problems in the housing market? Housing is, homes are typically assets that always increase in value. They almost never decrease in value. So this was a very unusual event in terms of our economic history. So what was going on? Well, in the early 2000s, there were several things that were causing home prices to increase relatively dramatically, like we saw in the graph. There were very low interest rates, so it was very cheap to borrow money. It was also, at the time, very easy for bad borrowers to borrow money. So we refer to them as subprime borrowers because they're very risky. There's a high chance that they won't pay back their loans. So for a number of reasons, it was very easy for these types of people to get loans for a house. And there were also government policies at the time that were in place to try to increase home ownership. So there was a lot of things supporting the demand for housing, which was helping the price to go up pretty quickly over such a short period of time. And then the real fuse in the powder keg was known as the securitization of mortgages, right? So a mortgage is just a loan on a house, and securitization of that just means that a bank would take a bunch of loans, a bunch of mortgages, and bundle them together into what's called a security. And it's basically an asset that you can buy for investment purposes. And basically the idea is that if you bought one of these securitized mortgages, you were basically buying a bundle of home loans. Um, and since, typically home values always increase, they were viewed as being very low risk. You would get a very safe return on your investment. That's how they were viewed. They were rated as AAA investments, which means they're among the safest investments possible, if they have a AAA rating. And so the way this worked is that investment banks purchased these home loans from lenders and created these securities, and the securities were backed by the loans. And then the securities were sold to banks, insurance companies, and other investors. And like I said, they were perceived as being very safe since house prices never fall, which was historically accurate, right? Home prices almost never go down. Um, but never say never, right? And so what started happening, mainly because of these subprime borrowers, is that I think it was the summer of 2007, um, a lot of people started defaulting on their home loans, which means they weren't making payments on their home loans. And that's a really bad situation, especially when it's a large fraction of the country. So people stopped making payments on their loans, um, which means that these securitized mortgages, these securities of bundled mortgages, um, should theoretically go down in value. And so that's kind of what was happening. There were millions of homeowners underwater, um, as this started to happen. So basically, since a lot of people were not paying their mortgages, a lot of people tried to get out. They tried to say, okay, well, I can't make my payments, so maybe I can just sell my home real quick, right? And there were millions of people doing this. So basically, the housing market was flooded with a huge supply of homes. And if you were to draw a supply and demand graph, and you increased supply, you would find that price goes down. Now, some people weren't able to sell their homes, but the value of their home was decreasing, and so a lot of people at some point got to a place where they actually owed more money on the loan than the value of their house, and that's, we call that being underwater. And the reason for that is because even if you could sell it, you wouldn't get enough money out of the sale of the house to pay off your loan. You owe more than the house is worth. So that's a really bad situation to be in if you're a borrower. And so there were millions of mortgage defaults, which is basically where people stop paying their payments, and that led to foreclosures, which is where the bank goes and takes your home away from you because you're not making payments, and then they typically sell it at an auction at a very low price, at a steep discount. And so this added to the downward price pressure, right? Banks were foreclosing on people, taking their homes away from them, and then selling them. And so that increased the supply of housing even further, which created more downward pressure on prices. And so this led to a housing crash. It badly damaged the construction industry. And the construction industry is one of the best sort of indicators of how an economy is doing. If the construction industry is doing well, then typically the economy is doing well. And so as this housing crisis got underway, the construction industry was badly hurt. A lot of people in the construction industry lost their jobs, and this kind of had a ripple effect into the rest of the economy. In fact, the unemployment rate in the construction industry was as high as almost 21% versus 7%, or no, not 7, almost 10% overall, right? The whole economy was experiencing unemployment of about 10%, but if you focused in on the construction industry, it was almost double that. All right, and so what were the consequences of all this? Well, those securities became toxic, right? They were deemed really, really safe because home prices never fall, right? but they started to fall, and so these mortgage-backed securities became just worthless assets. Um, and who owned these? Mostly banks and insurance companies. Now, we've seen what happens when banks' assets decline rapidly, especially if they're leveraged, which they were in this case. Leverage, remember, amplifies profits and losses. So when they started losing money on these mortgage-backed securities, it became a big problem because those losses were amplified by their leverage. And so this actually led to the failure of a lot of banks and other financial institutions. And there's actually something else. There's one more layer on top of this whole story that the slides don't go into, that your book doesn't go into, and that's something called credit default swaps. So not only were there these mortgage-backed securities that were quickly losing their value, but there were also these instruments called credit default swaps, which was basically insurance for these assets. Now, the problem is that a lot of insurance companies owned these very assets that they were insuring. So not only were the assets declining in value, but the insurance companies also had to make payments, insurance payments, to people that also owned these assets that were declining in value. But they didn't have the money because their assets were becoming worthless. So this cascaded into a huge financial crisis. It went from a housing market crisis and turned into a financial crisis. And so aggregate demand dropped dramatically, and we saw sharply rising unemployment and falling GDP. Okay. Now, fortunately, right, a lot of people were worried that this was going to be the second Great Depression. But fortunately, we have learned or had learned a lot of lessons over the previous 100 or so years, 90 years, I guess, about 80 years, actually. We had learned a lot of lessons in economics over the last 80 years since the Great Depression. And so we kind of knew what to do to get ourselves out of a bad situation. That leads us to discussion of the policy response. What did the government and the central bank do? Well, the Federal Reserve reduced the federal funds rate target to near zero. In other words, it dropped its key interest rate to almost zero, which has an effect on all other interest rates in the economy. So they're trying to bring interest rates down so to encourage borrowing and spending. Now, typically they do this by buying government bonds, but they went even further because it was such a desperate situation. So not only did they buy government bonds to increase the money supply to bring this interest rate down, but they also started, for the first time ever, buying other assets other than government bonds. So they actually started buying these toxic mortgage-backed securities as well as other private loans. So that was the Federal Reserve Bank response. There was also a response from our government, the U.S. government. So the U.S. Treasury injected a bunch of money into the banking system in order to increase the bank's liquidity and solvency to try to prevent them from failing and staving off a credit crunch, right? A situation where banks are very, very reluctant to lend any money. And so this actually helped the Federal Reserve Bank policy response, because if these banks failed, the Fed's response would not have much of an impact. So that actually helped boost the Fed's response. And then on top of that, Congress voted to increase government spending and reduce taxes. Okay, so this is the topic of the next chapter that we're going to look at is how these policy responses work. We can get a preview, perhaps here. So, oh wait, actually this is not a preview. So this is just, we were basically talking about examples in history of aggregate demand shocks. Now we need to look at some aggregate supply shocks. So here's an event that would affect aggregate supply. Oil prices increase, and we're gonna assume that it's a temporary increase in oil prices, not a permanent increase. And so since it's temporary, it's going to shift the short run aggregate supply curve. We're going to assume that the long run aggregate supply curve stays where it is. And basically, the reason this happens is because oil prices, right? Oil creates energy, and you need energy to basically produce everything. So when the price of oil goes up, the price of energy goes up, and the cost of production goes up. So in other words, it becomes more difficult to produce things. So this is going to affect aggregate supply, and it's going to shift it to the left. It's going to decrease aggregate supply. And that gives us a new short-run equilibrium where prices are higher and GDP is lower. Now, this is a very unusual situation. So this is a recession, and typically in recessions, we see the price level go down. But here, we have a recession, and the price level goes up. So this is an unusual situation. This actually happened in the 1970s. And it's a scenario that we refer to as stagflation. Stag meaning stands for stagnant, meaning that the economy is stagnant or suffering. And then, of course, inflation is for the inflation aspect. So lower GDP, but higher prices. Now, if policymakers don't do anything and we just leave the economy to its own devices, we leave it to fix itself, it's going to be the short run aggregate supply curve that gets us back to long run. And so in this case, the short run aggregate supply curve just shifts back to where it was slowly over time, perhaps. Now, the reason that the short run aggregate supply curve is responsible for getting us back to long run equilibrium is what happens in the labor market, right? So when we have a recession, there's higher unemployment, which means there's pressure for wages to stay flat or potentially even fall. And so when wages stay flat or fall, it becomes easier to produce stuff because labor is cheaper, or at least not getting more expensive. And that's what shifts the, let's see here, that's what shifts the short run aggregate supply curve to the right. There we go. Okay. But it's also possible that the government could step in or the central bank could step in and do something by either using fiscal or monetary policy to shift aggregate demand to the right instead of short-run aggregate supply. Now, this would get us back to long-run equilibrium, but it would lead to some inflation as well. So there's kind of a trade-off here. It might get us back to long-run equilibrium faster, but we're going to have higher prices. Okay, so like I said, this actually happened in the 1970s, at two different points in the 1970s. So in the period between 1973 and 1965, oil prices increased by almost 140%. And this definitely translated into inflation, right? The CPI, the Consumer Price Index, went up by 21%. That's pretty big inflation over just a period of 2 years. And real GDP fell, so we had a recession, and unemployment went up as well. This happened again later in the 70s, going into the early 80s. The increase in oil prices wasn't quite as bad, but we actually had a higher increase in price level, and real GDP went up, and but the number of unemployed persons went up as well, which is, I'm not really clear on how to interpret that, but anyway, let's see here. But yeah, so mainly this first one here, in the mid 70s, that's what we saw in the aggregate demand, aggregate supply graph on the last slide, was something like this type of scenario here. All right, now to sort of wrap up this chapter, we're just going to talk about this guy, John Maynard Keynes. Now, he was a very famous economist, and he was an economist during the Great Depression. And he wrote a book called The General Theory of Employment, Interest, and Money in 1936, kind of in the middle or kind of getting towards the end of the Great Depression. But he made this argument there in that book that recessions and depressions can result from inadequate demand, right? Low aggregate demand. And in those cases, policymakers should try to shift aggregate demand back to the right. And basically, what he was doing was he was critiquing the classical theory, which said that the government doesn't need to do anything. The economy just fixes itself. Don't worry about it, right? That was sort of the classical theory idea. But he had a very famous critique of it. He said that the long run is a misleading guide to current affairs because, after all, in the long run, we're all dead, which is a pretty kind of funny critique. And he continued to say, economists set themselves too easy and too useless a task if in tempestuous times they can only tell us when the storm is long gone, the ocean will be flat. Right? That's kind of that's a nice picture of his critique of the classical model, right? It's pretty useless for me to tell you that, yeah, when the storm's gone, everything will be calm, right? That's basically what the classical model tells us. It's not very useful when thinking about what's going on right now in the short run, right? We need some better model. And so he was actually the person that developed the aggregate demand, aggregate supply model that we just learned in this chapter. So, but he was the main motivator for fiscal and monetary policy that we're going to learn about in the next chapter here. So, all right. So to conclude this chapter, we were introduced to the model of aggregate demand and aggregate supply, which helps us analyze and explain economic fluctuations in the short run. And keep in mind that these fluctuations are when we deviate from the long run equilibrium or the long run trends that we've learned about in previous chapters. And so this is a great setup. We have to absolutely go through this chapter before we can talk about fiscal and monetary policy, but that's what we're going to learn in the next chapter. So, I know obviously this is a lecture video, so you guys weren't able to interact with me because we couldn't get signed into the portal, but I guess what that means is that if you have any questions or concerns, please reach out to me, email me, or you can even text me if you want. My number is 678-779-2211. I might even post that. I think it's posted on Moodle once we can get back into Moodle. But if you have any questions, please don't hesitate to reach out to me, and I'll see you in the next lecture video for the chapter on monetary and fiscal policy.